Hello guys, let's go for the chapter inventory today. Closing inventory. Now, this chapter inventory is tested in your O levels as well as A levels for the Cambridge and Edexcel student. Even if you are going for a qualification which is related to accounting, even after your O levels and A levels, still you should know how to do accounting for the closing inventory. What is this closing inventory? Why is this chapter very important for your final exams? Let me start. How do you measure this closing inventory? Let me do it with a different color. Closing inventory. Always remember, this closing inventory is measured at the lower of cost and NRV. Now you might be thinking, what is this cost? What is this NRV? Why are we recording the closing inventory at their lower of cost and NRV? I know when you're starting, you might be confusing, what is this? Why it's lower of cost and NRV? Let me explain this for you all in a practical way, guys. So it is lower of both. One is the cost, another one is the NRV. Now you all know, guys, this inventory is one of the important asset in your business. When you're running a business, inventory is one of the most important asset, guys. And when you're recording the asset under the current asset, the first inventory we have to record, we will be recording is what? Inventory. Now, how do you measure this inventory? It is the lower of cost as well as the NRV. So, let me explain you all this part in a practical way. Smartphones. I don't want to mention which brand the smartphone is. Just using as an example, I will explain you all. Now, you bought a smartphone, or you bought around let me take one smartphone. You bought one smartphone at the start of the year. You bought one smartphone at the start of the year. Let me smartphone you bought at start of the year at a cost of maybe $100 each. You bought a smartphone at the start of the year, $100 each. That means to buy each and every smartphone from your hand, you spend a cash at a cost of $100. So what is the cost of your smartphone? Cost of your smartphone will be $100. So let me record the cost here, the $100. $100 is the cost of the smartphone. Now let me come for the other part. End of the year. End of the year. Tell me, will the value of this smartphone will still remain at $100. You all know how smartphone works, how the prices of smartphone changes. For example, iPhone. When iPhone 15 was there, the price of this would be different. After the new iPhone 16 was introduced, obviously iPhone 15 prices will reduce. That is something normal. Whenever there is a new update in the technology, old assets value will reduce. That is something normal. Not all the assets, but mainly smartphones. When iPhone 15 was there and then they come up with the iPhone 16, when they introduced the iPhone 16 into the market, automatically iPhone 15 price will reduce. This is something normal. So at the end of the year, the smartphone price, you're estimating to sell each smartphone at a price of maybe $80. We call this estimating selling price. Estimated to sell the smartphone at the end of the year, $80. So let me write it clearly. End of the year, we are estimating to sell at a price of maybe around $90. And to sell this each and every smartphone, you have to spend a cost of, you have to incur a cost. This we can call it estimating selling cost. Guys, remember, this estimated selling cost can even be marketing cost or future modification cost. If it is a smartphone, you don't need any modification cost. But when you're coming with other kind of inventories, sometimes other kind of assets, in order to sell them in future, you might have to spend some future modification cost. Now here, at the end of the year, each and every smartphone you're estimated to sell it at $90 each. Each and every smartphone, you're estimated to selling it at $90 each. But to sell this smartphone at the end of the year at $90 each, you will have to incur a marketing cost. We call that estimated selling cost. A marketing cost of maybe $5 each. So finally, you're estimating to sell at $90, but still you will have to incur a marketing cost. You will have to incur from your hand, you will have to spend a marketing cost of $5 for each and every inventory, each and every unit of smartphone. You have to spend a marketing cost of $5 in order to sell them in the market at the end of the year. Now, what is the net amount you're coming up with by actually selling this smartphone at the end of the year? It is 90 minus 5 equals $85. This one we call it as NRV. Another one we call this full form. It is net realizable value. We call this net realizable value. Short form, easily we can call this NRV. We can also call this NRV. So now each and every smartphone at the end of the year, you can sell it and actually you can get a cash of only $85. So NRV, how do you calculate the NRV? Again, I gave the formula already. It is estimated selling price minus the estimated selling cost. How do you calculate this NRV? It is estimated selling price, estimated to sell at $90. Estimated selling price, which is $90 minus estimated selling cost of $5. Which means your NRV will be 90 minus 5, which is $85. So now your NRV is $85, your cost is $100. How do you measure this closing inventory? Closing inventory is the lower of cost and NRV. Each and every smartphone, to purchase each and every smartphone in my business, each and every smartphone to my business, I have spent a cost from my hand of $100. So by that time, I would have recorded an asset value of $100. But actually, at the end of the year, the real worth of my smartphones in the business is $85. Which means now, if I record again the inventory at $100 means I am trying to overstate the assets in my business, which is completely wrong. Actually, in the market, hereafter, by selling the smartphone, the actual amount of cash, the actual value of the smartphone I can get is only $85. I can only get a cash of $85. That means the real value of my asset is $85, not $100. So in this case, if I'm measuring the closing inventory is valued at lower of cost and NRV. Now I'm comparing the cost with my NRV. Cost is $100. Okay, the cost is $100. Fine. But the NRV is $85. Remember, if I'm recording my inventory again at $100 means I'm doing a mistake. Hereafter my asset is not $100. Hereafter my closing inventory is not $100. It is wrong. I can't record it at $100. Why? The actual value of my smartphone, actual value of each and every unit is only $85. So the value of my closing inventory will be $85 because that is the lower when you're comparing the both. Cost is $100, NRV is $85. So I'm comparing both. Obviously, NRV is lower. So this is the value of my inventory. So my closing inventory value will be, remember, closing inventory value is finally closing inventory value is equals to $85. $85. Some people are there, they will go and record it as $100. Remember, here you compare the both, you compare the cost with the NRV. When you're comparing, obviously, here you can see from your eyes, NRV is lower compared to the cost. So remember, the closing inventory value is only $85, which is the NRV value. So now, how do you calculate NRV? It is estimated selling price minus the estimated selling cost. So NRV is equals to $85. Cost already I know because at the start of the day I bought each and every smartphone at a cost of $100. So my cost is $100. NRV is $85. How the NRV is $85? At the end of the year, I'm estimated to sell each and every smartphone at a price of $90 by incurring a selling cost, spending a selling cost, spending a marketing cost of $5 for each and every smartphone, and my net realizable value, which is the NRV, is $85. So NRV is $85, cost is $100, lower is the NRV, $85. So the value of my closing inventory, it's very simple, it is $85. This is the value of my closing inventory. I'll record in my financial statements. That part I will come later. Now, let me change the question a little bit. What am I going to change now? Cost. It is already at $100. We know that. Cost is $100. Now let me change the NRV. What am I going to do? Now there is a small change in the question. What is the change? Only the end of the year. The NRV I'm going to change now. Now there was no any new smartphones introduced into the market. So only my smartphone is latest in the market, even at the end of the year also. And so I'm estimating to sell each and every my smartphone at a price of $120 each at the end of the year in the market. But to sell these smartphones at $120 each at the end of the year in the market, I will have to spend a selling cost, a marketing cost to sell each and every smartphone at a price of $120. I will have to spend a marketing cost, selling cost, incur a cost of $10 each. So now my NRV will become $110. 120 of estimated selling price minus the $10 of estimated selling cost, which is my NRV is now $110. So I'm recording the NRV as $110. Okay. How it's $110? Estimated selling price is 120 and estimated selling cost is 10. Now my NRV will become $110. Now, our people will get confused by not studying the concept in both the ways, guys. Remember, sometimes NRV can be lower, but sometimes still the cost can be lower. Now, in this situation, the NRV, net realizable value, at the end of the year, you're realizing you can sell the smartphones in the market and actually at a price of $110. You can get a cash of $110. But still the cost is how much? $100. Cost will always remain the same. Cost will always remain the same. Cost is always going to be the same. So cost is $100. NRV is $110. Now which is lower, guys? Comparing the cost with the NRV. Obviously now the cost is lower. Some people, what they will do, always the inventory value is NRV. They will think with a wrong concept, wrong understanding, and always record the inventory of NRV. That is completely wrong. Always remember, you will have to compare the cost with the NRV at the end of the year, and then only you can come up with the closing inventory. Always remember, you will have to compare the cost with the NRV and then only you'll have to come up with finally the closing inventory value. Now still, even in the market you can sell your smartphone and get a cash of $110, still you will record the asset at $100 only. So what is the value of my closing inventory? Closing inventory, the value is equals to $100. It's not $110. Why? Lower of cost than NRV. NRV is $110 and the cost is just $100. So the lower is obviously the cost. So my closing inventory value I will record in my financial statement is $100. That's it with the concept of inventory. Remember, this part is a very easy part if you understand the concept properly. And we have also the double entries, journal entries are also there to study how to record a closing inventory. Those things we don't need to discuss now. Let's discuss only how to record this and at what value you have to record this. Now, I hope it is clear. The closing inventory value is $100 at this situation. Why the cost is lower compared with the NRV. So now we are done with this part. Now let's try one question and we'll also see what are the places you will have to record this closing inventory. Let me change the page. Okay. I have given a question here. What is the value of my closing inventory? Okay, first of all, let's read the question. Business bought 3 items of inventory to the business at a cost of $100. Let me change this part. Business bought 3 items of inventory, and the 3 items are given here, which is the item A, they have bought at a cost of $100. Item B, they have bought at a cost of $80 each. Item C, they have bought at a cost of $180 each. Item A, they are estimating to sell at a cost of $100, at a price of $100 by spending a selling cost of $20. Item B, they are estimating to sell it at a price of $100 by incurring a selling cost of $10. And item C, they are estimated to sell it at a price of $200 in the market and by incurring a selling cost of $50 each. Now let me check the value of NRV. You all know how to calculate NRV. How do you calculate NRV? It is estimated selling price minus the estimated selling cost. Simple. So only these two things are relevant to come up with the inventory, to come up with the NRV value. Estimated selling price is $110. Estimated selling cost is $20. So 110 minus $20, my NRV will become $90. And item B, I'm estimating to sell at a price of $100 by incurring a selling cost of $10, which is my NRV is again $90. And item C, I'm estimating to sell each and every unit at a price of $200 by incurring a selling cost of $50, which is my NRV is 150. Now let me come up with the value of the closing inventory. Closing inventory. You all know inventories are valued at lower of cost than NRV. Now it is very simple. Our life is going to be very simple. We have the cost of the each items. Also we have the NRV of each items. Cost of the item A is $100. Cost of the item A is $100 and the NRV of item A is $90. When you're comparing, by seeing your opening your eyes properly and just checking, guys, it's very easy. The cost of the item A is $100, NRV is $90. Now when you're comparing my $100 with my $90, okay, my cost is $100. Cost of my item A is $100, but the NRV is only $90. Which is lower, guys? It is very easy. The lower is $90 of NRV. So the closing inventory value of item A is $90. Next one, let's go for item B. Okay, item B, the cost is $80. Each and every item I have bought at a cost of $80, item B. But when I'm checking my NRV is $90 now. Wow, the cost I have bought my item B is $80, but at the end of the year, the NRV, the market value, which I can sell my inventory is $90. But still, we value the closing inventory by the lower of cost and NRV. My cost is $80, my NRV is $90. Which is lower? Obviously, my cost is lower here, which is $80. So the value of my closing inventory is $80. Next one, the item C. Item C, I have bought at a cost of $180. And the NRV, which I'm expected to sell my each and every item CE at the end of the year is $150. Now I'm comparing my cost with my NRV. Comparing the cost with my NRV. Cost of the item C is $180 and the NRV of item C is $150. When you're checking which is lower, 180 is lower or 150 is lower, it's very easy guys. 150 is lower. So the value of my closing inventory now it's $150 for the item C. Now, when you are getting the value of closing inventory, we have done during the calculation, inventories are valued at lower of cost than NRV. So I compared the cost with the NRV, I took the lower. Now what is the value of my closing inventory totally? 90 plus 80. 90 plus 80 is equals to how much guys? It's 170. 170 plus 150 is equals to 320. So 320 is the value of my closing inventory. Now we are done with the requirement A. What is the requirement A guys? Calculate the value of closing inventory. So the value of my closing inventory now completely it is $320. I'm done with my requirement number 1. Option A. This can be your one exam question guys. In exam also, examiner can ask you all calculate the value of closing inventory. And it is very easy, the chapter inventory. And trust me, this is tested in many accounting places guys. Many qualifications also even. Even when you are going for the qualifications like ACC and CIMA also, those places also, you have this question where it is very easy to score a marks. But our people don't study the concept properly. They think that it's very hard and they don't understand this. They are always, some people's understanding is still there. Always NRV is the value of inventory. No. Always remember, you compare the cost with the NRV, net realizable value, and which is lower, that is the value of your inventory. Now we are done with the first requirement. Calculate the value of closing inventory. We compare the cost with the NRV and finally we got the closing inventory value. Now, requirement number B. Sorry, requirement B. What is the requirement B? Show the extracts of financial statements for the closing inventory. Now we found the value closing inventory is 320. No point of finding the value if you don't know where you have to record this. But guys, there is a journal entry, there is a double entry where you should know how to record this closing inventory using a double entry. There's a double entry system also. Journal entry is also there. But I will explain you all just what are the places you have to record this closing inventory. The value we found, it's $320. 2 places you record the closing inventory. One is under statement of financial position. You know inventory is a current asset. So the first important current asset I will be recording is inventory. The value of the inventory is $320. The other place where I will have to record this closing inventory is under statement of profit or loss. Under the cost of sales, it's opening inventory plus purchase minus closing inventory. 320. Remember, this closing inventory will decrease your cost of sales. Why opening inventory will increase your cost of sales? Sales minus cost of sales is equal to gross profit. That is perfect. But how do you calculate this cost of sales? Cost of sales is equal to opening inventory. Opening inventory will increase the cost of sales plus purchase. Purchase also will increase your cost of sales minus closing inventory. Closing inventory will reduce your cost of sales. It's minus 320. Now, I explain how do you measure this closing inventory, as well as I explained you all what are the places you will have to record this closing inventory. Remember this simple thing guys, this is there in your O-levels as well as your A-levels also. An easy concept to understand.